It was a bumpy ride for the HODL Factory in the fourth quarter of 2024. Hutch and I watched our lead completely evaporate in December, but this thing is far from over. We welcome 4 new positions in our quarterly meeting, and we think that the portfolio is positioned quite well moving into 2025. In this video, we'll cover the specific fourth quarter changes, and we'll dive into a detailed performance history for the first time ever. I wasn't hiding anything before, but now I have a shiny new tool to assess our performance. I can't wait to show you this one. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please headshot that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had a whopping 5 new channel members for our Sunday shoutout. A huge shout out to MB, Abby, Steve, Raj, and RB. Thank you to all 5 of you for joining this wonderful community. And of course, thanks to all of you that have been here all along. As many of you know, I have yet to have a sponsor on this channel, and it's not because I don't like making money. I like to keep things 100% authentic when it comes to my recommendations, things I actually use. And I've told you all about my Seeking Alpha link, which I love and highly recommend using, but I have that link because it saves you money. Of course, I do get a kickback, and you get to support the channel for no additional cost. But the important thing is that you get access to a great service at a discount. And I know from first-hand experience because I used to use other YouTubers' Seeking Alpha link for years before I started my channel. I'm happy to announce that I have a second affiliate link to a portfolio tracker that I think is awesome, Snowball Analytics. You'll soon find out what it's all about because it is what we will be using to assess the performance of the HODL Factory in this video and in future videos. If you think that it could add value for your situation, consider using my link in the description below to give it a try. I think it's like Seeking Alpha in the sense that deals will come and go. I used Ryan Williams' link to sign up recently myself. He's an awesome dude, and I highly recommend checking out his channel if you're into dividend investing. Okay, you know what time it is. Let's grow. HODL Factory origins and methodology. I co-manage the HODL Factory alongside my longtime best friend. Although he's an ER doctor that isn't directly involved with finance for his day job, make no mistake, Hutch is an investing nerd just like me. The HODL Factory was born on 4/20/2023. It's far too early to declare victory or defeat at this point. All of our long-winded conversations over many years that I'm sure our wives found invigorating ultimately led to 2 primary goals for the portfolio. We would like to keep up with the total returns of the S&P 500, an extra bonus if we could outperform it. That's hard to do, as many know. And another one, because we're buy and hold investors that are in this for the long term, we'd like to outpace the dividend CAGR, compound annual growth rate, of SCHD, which is known to be particularly high. Our dividend CAGR is at 22% since inception. We have obliterated that goal so far. And although our total returns did massively dip in December, we're doing okay. And we'll get into that soon. For our methodology, we start with a tough to pass screener, and we did make minor changes to it in the fourth quarter. We had an all-time high of 235 companies that passed the screener and moved on to the scoring spreadsheet. The scoring system weighs 12 key metrics by importance to get a total score. 25 companies are held in the portfolio at any one time, and we do have rules in place to avoid high turnover that I won't bore you with the details in this one. Let's open up the curtains to see what happened in the last quarterly meeting. Quarter 4 2024 update. We had a higher turnover than usual in the fourth quarter. Let's hop over to my screen right now to see why 4 tickers were shown the door and to see who joined the party. Here's a spreadsheet that has all 25 of our holdings prior to our last quarterly meeting that we just had in late December. And it's probably pretty obvious at this point which companies were ultimately dropped. You can see we let go of Microchip. And then this column here in B, I just put a quick note of the primary culprit of why it was dropped. We have quite a few steps and trends and things that these things go through, but payout ratio was the downfall of Microchip. And then we dropped Nucor as well. and it was due to its poor rank within the 235 companies that made the spreadsheet. I'll get more into that here at the end. And Reliance was let go because of its net income, and more specifically net income trends with some of the aggregate data from the spreadsheet. And then Steel Dynamics was dropped due to rank. So what we do, and this is part of that thing that I spare you each time because there's a lot of nerdy little aspects to this stuff for us. On a quarterly basis, any company of all the ones that make the screener that fall outside of the top 100 companies will be sold, assuming they're carrying an unrealized loss. So this is a little way to auto tax harvest. It's nothing major. So if these were green, they would make it until the March screener, which is a little more stringent on our reconstitution. So ultimately, Nucor and Steel Dynamics were an unrealized loss. So getting rid of these and creating higher turnover was actually a good thing for taxes. As a matter of fact, all 4 of these were carrying a loss. So it was actually a good tax quarter for us, regardless of the turnover amount. And then I want to quickly jump over to a different tab within this spreadsheet. And there's a whole bunch of tabs here, and I'm not going to show all the secret sauce. This has the scoring algorithms and everything on it. But this particular tab is just a very high-level summary with some pretty basic key metrics that most people look for in general when assessing companies. These aren't necessarily the screeners or the scoring systems themselves. And you can see here that all the yellow companies were held prior to the meeting and retained. So these are some of the names we've been holding on to for a while. And then our new additions were Badger Meter, and it's a technology company, Hess Energy company, of course. And then SM Energy is an energy company. And then Windmark Corporation is a consumer discretionary resale. It's like Plato's Closet and a few other things. And the key metrics are looked up for each one of these companies individually. You can see its 3-year dividend CAGR, 5-year dividend CAGR, its forward yield, net income percentage, that's for the trailing 12, like a full year, 3, 5, and 10-year total returns, trailing 12-month PE ratio, and then a forward PE ratio. And we really like the mix we have here. We noticed the 3-year CAGR just skyrocketed up to 29.5. And then the 5-year dividend CAGR is a fairly staggering 21.2%. And we'll see in Snowball Analytics that this is justified. Hutch and I always think like, that's great. I know the math is right. Like they're all properly weighted on the averages with some products and everything, but it seems too good to be true, but it's not. We'll get there. We have a low forward yield of 1.36%. And our trailing 12 is actually worse than that. We'll get into that. Now, this net income percentage is quite wild. A weighted average of 29.3%. And then the 3-year return, 5-year return, and 10-year return. These are more what ifs because we didn't hold them the whole time. But still, pretty impressive on the what if. And then our trailing 12-month PE ratio at 25.4. That is pretty good. It's slightly lower than the market, which is a good thing. We're scooping up a little more value. So we're really excited about this new mix, and later in the video, we will dive into exactly why. Hutch and I are looking forward to our next quarterly meeting in March. We have a few extra rules baked into the once per year reconstitution. But for now, let's see how this thing is performing. Detailed results via Snowball Analytics. This analysis will come with fewer disclaimers compared to using Portfolio Visualizer like we did in our past videos. Snowball Analytics will show exactly what has happened since inception. I even took the time, because I'm nerdy and I can't help myself, to cross-check the Snowball results against a spreadsheet that I made, Portfolio Visualizer, M1 Finance, and Seeking Alpha. I can say with 100% certainty that it is pinpoint accurate to the dollar. But we do still have a major disclaimer before diving into the data. I do not recommend investing into the HODL Factory with a large portion of your net worth. Hutch and I are pumping our holdings up over time, but it is still less than 2% of each of our portfolios. And I think it has promise, as we'll see here in a minute, but this is far from a finished product. If you do want to get into the HODL Factory or something similar that you build on your own with your own methodology and screeners, that's fine, but I recommend building it slowly from the ground up. Most of our portfolios should be in low-cost, broad market ETFs. Okay, enough disclaimers. Without further ado. Okay, I'm a little bit of a tease here because this is not Snowball Analytics quite yet. I just wanted to point out that there is a spreadsheet for free for anyone to go look at that I update every Friday that will show the performance of the HODL Factory with the portfolio performance based on profit percentages. And this is from Snowball Analytics, and we'll get more into that here in a minute. A year to date, I mean, this is updated every Friday, so it's only 10 days into the year. But you can see the HODL is ahead of VU and SCHD so far on year to date. On the trailing 1 year, VU was ahead of the HODL Factory, 11.92% to 10.04 as of last Friday. It's been a couple good days. Just stay tuned here. And then the overall, as of Friday, the HODL Factory is up 16.37% since inception. And again, that's profit percentage. This properly handles all my contributions and shows what it's actually made compared to essentially being in interest-free cash. Whereas VU was up 16.34, so we were just eking out a win. And SCHD, yikes, we won't get into that. But I just wanted to point out that you can come out and look at this anytime, and it's updated weekly. And there's some cool high-level stats here. We won't dive into them right now because we're about to jump to something much cooler. All right, we have arrived. We are out on Snowball Analytics. And this is the one that I have vigorously tested, and I absolutely love it. So I hope this one doesn't stretch too long, but since it's officially the OG video of Snowball, I might go through a few of these features, one tab at a time. We're gonna start here on dashboard. This is when you first log in. We're on the HODL Factory. And on the dashboard, you get the current value of your portfolio, which right now we have $18,600. Total profit, and again, this is from unrealized, realized, and dividends, $3,016 is what we've actually increased by since inception. And we'll get more into some charts here in a minute. And then your internal rate of return. This is your annualized return rate. And this will become a cooler metric. I mean, 23.16 is amazing, but we know the market's been great too. And we haven't been around that long. So we'll have some good years and some bad years. And hopefully over many years, we keep this above 10%. And then the passive income is just a high level dividend view. We're at a 1.12% yield. So this is pretty low yielding stuff, but a 22% compound annual growth rate of the dividends. That is incredible. SCHD is probably the best ETF I've ever seen, like of the regular ones with no weird strategies. And it's 11.5% since inception. So Hutch and I are really happy with this figure right here. But then we get the portfolio breakdown. It has all these bars over here, but it's a little easier for me to see tables. So we have 5 energy companies, 5 financials, and 5 industrials with a target allocation of 20% each. But because of the gains, energy's sitting at 22%, financials is right about its 20, and then industrials is right in there at its 20s. And then information technology and consumer discretionary have targets of 16. You can see tech has overperformed, consumer discretionary is slightly under, and then material has done pretty poorly, the 2 items there. And from their 8%, they're down to 7.9. Now, something I love about M1 Finance, where I actually do my investing, that's the portfolio that's connected here. And normally I'm out there showing that, but this is the analytics site for it. But as I put my $100 in of my YouTube money that I make each and every week, it automatically buys the dip. It buys the ones that are the most beat up. But because it's in a taxable account, I don't want to rebalance all the time and have to recognize a bunch of realized gain. We have some solutions for that, and we'll get into more of that in the future, but real time, we're buying to our target allocations thanks to M1 Finance. We're out on the analytics, which is probably the last tab we'll visit. One thing I like about this common tab out here, when you're out on M1 Finance or Fidelity or E-Trade or Seeking Alpha, you can always see your total gain, right? And usually it's called total gain, even though it's technically just your unrealized gains. It does not include realized gains and dividends. This one out here has total profit. And the thing that's unique about this is it does include, as you can see here on the ticker, dividends and profit from sale, in addition to your unrealized gains. So this is the full story of what each company has produced for you long-term. Like hovering over this one, you see there's some capital gains there, all unrealized, and dividends received. So it'll break down the entire picture for each one of your companies, which is really neat. I have them descending from the best to the worst. And again, I've held these for a different amount of time. So like Texas Pacific Land Corporation, I've had for a while. Granted, it has been a beast, and we'll get into that. And some of these other ones have been around for a long while. Hawkins is actually relatively new. It's done very well in a relatively short amount of time. But I'll scroll here. We can see some of the holdings. Where is Microsoft? Oh man, Microsoft's really fallen from grace. Then here's some of the new ones. Of course, they're going to be even, Badger, Winmark. SM's actually, where is SM? This is kind of a wild note. We literally just bought SM in late December. I'm recording this on January 14th, and it's already our 6th best producing company by total gains of all time. That's pretty wild. Some of these we've had since inception, or very close to. And same with Hess. And energy's been on a wild run. We'll dive more into that. But before we dive into that, let's check out the dividend tab because, oh man, this is cool. So you have your yield, you have your dividend growth. We've gone over that, an incredible 22% CAGR. One thing I really like is this yield and yield on cost by each company. So for example, we saw that TPL right here had a huge run up. We've made a lot of money. So it only yields 0.48%. That's its actual dividend yield. But our yield on cost is 1.12% because of the wild amount of appreciation we've had. And you can see MLI is similar right here. But then you look at something like Devon Energy, we're upside down on it. It's in the red. And that's why our yield on cost is actually lower than the actual yield as if we bought it today. You have some dividend ratings here. I don't know about these. I think these are all safer than this. Okay. Well, maybe. But most of ours are reliable, which is the best. And they're 98s and 99s out of 100. We have quality companies. And then you have some safe ones, quote unquote. And then okay, I guess. Oh, I'm sorry. Here you go. So you can tell I wasn't just lying. We have lots of 99s, and they're relatively rare, I would say. Some in the 90s. What's that? Rating calculation based on incomplete information. Oh, that's not great. But when you come down here, apparently we have a couple below 60, but still nothing that's a red flag. 49 is our worst. I'm still getting used to what all the particulars mean with these systems. The last one we'll dive into before moving into the performance charts, we have dividends received. So this is going to be a little goofy because this thing started in 2023 and a lot of our money is just like seed, like funded money that I've put into it since beginning. That's a lot more of that than growth. It's not like it's been around for years. So of course the actual dividend payments are gonna be way higher. It'll be a similar story for 2025, I would think. Not quite as extreme because I only put in 100 a month and it's already up to 18,000. But the actual 22% growth is legit because when you look here, in December, we received 3160 this year as opposed to 930. So that's over triple. But the growth rate is only that 22% because it does properly account for our contributions versus actual growth. So the real true per share dividend growth really is 22% on the CAGR. We started here in May. We've significantly increased the dividends. Again, most of it being a little cheating because of new money, but still, we're looking at 20 versus 7, 10 versus 4, 10 versus 5, and then the big one here. So I expect that trend to continue. Okay, we're still out in the analytics and we are on the growth tab. This is the coolest thing since sliced bread. What this does is this says our portfolio has produced $364 more than VU would have with our contributions, which are the green dotted line. Again, most our value is contributions up to this point. But if we put every dollar into VU instead of our portfolio, we would have 364 fewer dollars. And the same concept with SCHD. Our portfolio is ahead of it. And we know SCHD has struggled by a whopping almost 1,600 since inception. This is just a big picture view, and I always use all because it's kind of goofy to break down the time periods on this specific one when you already have contributions. What you really want is down here. Like here's the performance, total returns that we know and love. And again, this is profit percentage. So this is your unrealized, realized, and dividend gains. So we have our portfolio as the blue bar, VU as the orange bar. Orange happens to be my favorite color, but VU is not my favorite because the HODL Factory is. And the purple bar is SCHD. And again, you can use any ticker. We'll probably experiment with different things, some VT out there and do some other stuff. But for reasons I mentioned in this video, VU and SCHD have been our benchmarks and barometers for different aspects of them, of what we want from our hybrid fund ultimately. So you can see on all our profit percentage, again, it's gonna be a little lower because a lot of this is our own money. So it properly shows what you've actually gained, is 19.3%. VU is up 16.82%, so we have it on the overall by a decent amount now. And again, the spreadsheet, we've had a killer 2 days this week. That spreadsheet we just looked at, where we were basically tied through the all, was only 2 market days ago. But this thing, whew, it's been going ham over these couple days. It knew I was making this video and it didn't want to make me look that bad. And then SCHD is up nearly 9%. And see, and you can see that I'm not crazy here. And we were losing here, and I updated it like, it's not going to show exactly, but I updated right there, like right when we had basically were tied and had just passed it. That's my story, and I'm sticking with it, and we've had a couple really good days. But what I want to focus on, this is the 4th quarter update. So I'm not going to sit here and pat myself on the back and just try to look as pretty as possible. Wipe the lipstick off of this pig. Okay, I knew this was going to be ugly, but man, I put in Q4 date ranges, just standard Q4, October 1st through December 31st. 2024, of course, and holy Moses, we were down almost 7%. The market was up 2%, and SCHD was horrible. It looked like a supermodel compared to us, being down 2.4% only. That's pretty wild right there. When we go back to all, we're gonna look at the elephant in the room here. We're kicking butt, just like I showed in some previous videos. So you know I wasn't lying all along when I said we were winning basically since inception, almost. And as you can notice, from December 1st, ironically, it's like perfectly a month, from December 1st to December, basically, yeah, 29th, like all of December was a literal free fall for us. And energy was not happy during that time. We'll get into that here in a minute. And here's a quick month by month returns. You can see in October, we were down a little, but not too bad, 1.8%. And we came back and won in November. So Hutch and I were feeling pretty good at that point. But then in December, again, down 11.5% in 1 month alone, versus VU only down 2.3% and SCHD down a pretty monstrous 6%. But I mean, you thought SCHD was bad. I'm here to make it look beautiful. Okay, and I wanted to look into December. I had to resize the screen. I hope, yes, I think you can see this all. So this is really neat. I love it. I'm on all right now. So this is just showing that TPL was our #1 gainer since inception at 134%. That's pretty wild. And you can look down the list, MLI, and then FCNAC. You have Hawkins there, Parker and Hannafin, SM Energy, KLA Corporation at 16%, then Hess Energy. It goes down, Visa. You can see most of our positions are green overall, which you would hope would be the case. But then some of our new guys here, and Old Dominion, Devon Energy, it's relatively new, and MPWR, they're lifetime down. Let's take a look at December to see how on earth we were down 11% for a single month. And you can see that Hess and SM, they're energy companies, and they were up. Remember, they were added late December, but in early December specifically, like our best performing stock in our portfolio by far and away overall, TPL was down 31%. Old Dominion, 21%. PHM, 18%, Carlisle 17%, Toll Brothers down 16%. I mean, it was just a brutal month. Devon Energy here. Energy had a rough go, EOG, in this month. But again, it made a late push at the very end of December when we bought these. So these energies look okay. But it was just a crazy down month for the sectors that I happen to be heavy in, kind of like SCHD in a way, which is interesting. Even looking at the last 3 months, TPL is right back to being our best performer, if you zoom out a little. So far, so not terrible. Moving on to the future. The HODL Factory is my favorite part of investing. We have a blast with this thing, and I think it has great potential over the long run. And even if it doesn't work out, it gives Hutch and me a reason to get together, drink too much, and pretend like we know what we're doing. I know that I commonly put out cautions and disclaimers, but really I think that applies to all investing. Truth be told, I do believe in our process. The goal is to build a portfolio that captures price appreciation while also paying and growing reliable dividends. I think we're well on our way with this one, and I can't wait for our reconstitution in March. Thanks for staying with me until the bitter end. You are one of the real ones. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you here in the next one. Peace.